Welcome back, ladies and gentlemen. This is Greg Silverman, your outsourced Chief Investment Officer and outsourced Chief Financial Officer. Another session of Come Learn With Me, where we take a look at articles that did well over the last few weeks. How to think about investing during a recession. Yes, a very prescient article by Charlie Bilello. Charlie's a famous investor. Get where from, probably Compound. Let's read it. Is the US economy in recession? Everyone seems to be asking that question. Why? Likely because we just learned that real GDP contracted for the second straight quarter, and the last 10 times we've seen consecutive quarters of negative economic growth, the US was indeed in a recession. Data going back to 1947, we've never seen a two-quarter decline in real GDP of this magnitude without the US being in a recession. Still, many are not convinced, pointing to the jobs data, which continues to be strong. The US unemployment rate has moved down to 3.5%, back to pre-pandemic levels, and at a 53-year low. Wow. And so the heated recession debates will likely rage on until we get an official announcement from the National Bureau of Economic Research or see a sharp turnaround in growth, all of which is creating further angst among investors who have already faced the most difficult start to a year in recent history. Total return through July. Wow. Pretty bad. And angst is not a particularly good emotion to have, as it tends to precede actions like panic selling, and that can be deleterious to the long-term health of your portfolio. Which begs the question, should an investor be thinking about it as it pertains to recessions? Here are a few things to consider. Recessions happen. Since 1871, there have been 30 recessions in the US, averaging 1 in every 5 years. And in spite of that fact, the S&P 500 has gained 6.9% annualized over that time, after adjusting for inflation. There's been no better long-term build of wealth in the last 150 years, and recessions are a necessary part of the package, for there's no upside investing without intermittent downside. There's the S&P 500 real return, January 1871, so wow, a long time. Civil War days, from the Civil War. Timing isn't everything. Still, wouldn't it be better to sidestep recessions and related stock market downturns altogether? It certainly sounds tempting. Let's say you were the best economist that ever lived. You knew exactly when recessions would start and end in advance, moving to cash 3-month treasury bills during recessions and stocks only during expansions. How would your returns have looked since 1928? 10.7% per year versus 9.7% for a buy and hold. Oh, since 1928. Okay. Not bad until you dig into the data and see that all of the outperformance came from avoiding the bulk of the losses during the Great Depression, when stocks declined 86%. Since the Depression, if you were able to time every single recession perfectly, you would have underperformed with a 10.6% return versus 11.7% for buy and hold. In reality, no one could have predicted every recession with such precision. Let's say instead you were early in getting out, moving to cash a year before the recession, getting back to stocks a year after it ended. Or more likely, let's say you were a little late and moved to cash 6 months after the recession started and moved back into stocks a year after it ended. That would still be pretty remarkable timing. How would these scenarios have fared? Worse than a simple buy and hold. And this is not factoring transaction costs and taxes, which could skew the results in favor of doing nothing. How is that? The stock market is not the economy. It often starts going down before the economy turns south and starts backing back up before the downturn ends. Getting a timing right on both ends is nearly impossible. In trying to do so, you're likely to cause more harm than good. Don't wait for robins. Maybe you can't time a recession, but why should you invest new money when the economy is contracting? It would be better to wait for. Stay diversified. Don't find the last war. Good advice. This year, inflation is the biggest concern for most investors, and the only thing working has been commodities. Low back in 2020, when crude oil futures turned negative, the opposite sentiment prevails as inflation hedges. They become the most popular vehicle of choice, while having a percentage of your portfolio in assets that may benefit from a period of high inflation is certainly reasonable. Going all in on a single commodity after a huge run-up is not nearly the same thing. Don't fight the last war. What's the answers? What's the answers. One constant is that all recessions bear market in the past be ended. New expansion all time following at some point in the future. They're all things to worry about today that should be comforting thought for long-term investors. Historically, if you stayed the course, you were eventually rewarded. That's been true regardless of whether the economy was deemed to be in a recession. He's got a point. Peter Lynch is great. You get recessions, you have stock market declines. If you don't understand that's going on to happen, then you're not ready. You won't do well in the markets. Now, take a look at some of the links below. Look at some of our niche investment groups and sign, subscribe, and like. Thanks. Greg Silverman out.